Yeah, I'm losing my
Here, get $100 there to do so. So I don't mind that, but we have to get into, I would love to hear your thoughts on crude, but we have to get into this stuff here, Mikey. Market price and mean reversion. Mean reversion, an essential quality to look at whether you're trading stocks, whether you're trading futures or options, any derivatives. And I think it makes sense for you to maybe kick this one off, because I was probably taught mean reversion in the interest rates realm, and how those interest rates, the 10-year, for example, can get up to 5 or 6%. It can get down to almost 0%. But over the course of many, many years, it tends to do a dance around an average price, where you probably picked this up, Mikey, and please explain for everybody out there, is probably centered around volatility and buying and selling options. Am I wrong?
No, it's completely right. And the easiest way to understand mean reversion is to literally just look at a VIX chart. And this isn't to say that we know exactly when volatility will revert. We saw probably one of the most elongated expansions when we saw the initial COVID crash, where VIX futures were in backwardation for a sustained amount of time. Volatility was significantly higher for sustained amount of time. So that was the longest experience I've seen, where the VIX was above 30 for quite some time. But yeah, it is like you see here, you have your peaks, you have your troughs, and that's what we're talking about in terms of mean reversion. Just we're going to see the spikes, but because of the nature of the product, we know that at some point it's going to come down. We don't know when exactly, but based on history and based on just how this product is structured, we know it will come down at some point, which we see time and time again. Very similar to these other products we're talking about, like the commodity space.
Exactly right. And before we get to commodities, I do want to talk a little about rates, because they are picking up here. Everybody's finally talking about interest rates the last couple of weeks and months, and it's because interest rates themselves have been picked up off of their lows. And if you'll recall, in 2020, when the 10-year rate is at its lows, a lot of people saying, oh, it could go negative. It could go to this crazy uncharted territory. But as high probability traders, we always like 99 times out of 100, what's it going to do? And this is a market that most times out of 100, it's going to revert back to its average price. And I don't want people to have the takeaway of like, oh, well, then it's as easy as selling high and buying low. It's not that easy. And we'll get into some ways to deal with the uneasy parts. But that concept does kind of track if you have the right market, like we say interest rates, or like we looked at with VIX. And, when VIX pops, that implied volatility goes from its average price around 20 to 30, 40, 50 even, and you sell options, it does at some point come back. And of course, you have to have defensive mechanics to deal with that part at some point. I don't want to leave that hanging there, but it's same with buying and selling futures markets. And also you look at crude oil here, where yes, it's been up to 100. Yes, it's been down to $20 or even lower, depending on the futures that you were looking at in 2020. But every single time, Mikey, it's come back to around 60, $70. And this only works for a particular number of asset classes. But I feel like we are in this mode that we get into every once in a while, especially in commodities, where it's like, oh, lumber prices are crazy high right now. And then inevitably they come lower, and then everyone's like, they kind of forget about it. And we're kind of in the midst of that with a little of this crude oil talk, where it's like, oh man, we're at 90. This market's going to get to 120 and beyond. Most of the time it's going to mean revert back down to its average price, right?
100%. And these are the types of, and getting into like why you can just short it or get long it, but there's still going to be volatility. You still have to consider trading small, so that if you are wrong, like in these periods where it just continues to the downside, even past these hashed lines, like if you're trading small enough to hold it, then that's great. But if you're not, you're going to be stopped out at some point. And that's one of the biggest reasons why we like to trade small, so that we can hold through this volatility and this unknown potential volatility against us. And I think the best example is like where it got over 100 here. If you were shorting it at 85 in a small way, you could have held it. But if you're not, you might get stopped out, and getting stopped out is, not a great feeling.
That's the feeling we want to avoid, especially with long-term, large, more volatile asset classes like the crude oil here. I'm so glad you brought that up though, Mikey, because that's where I want to conclude today, which is, this piece of like, oh, well, what happens these multiple years here and actually it's not even multiple years, but, it shoots up to 90 or so in 2011. It gets up past 100 and then comes crashing back down to the 70s. And then it does it again in 2012 and then it comes back. You have to deal with that time. And that's what makes trading such a beautiful game, is that like derivatives, especially futures and options, you have to be right, but you also have to be right in a certain timetable. And if you don't have the correct defensive mechanics, you didn't get small, you went with the big crude oil contract, you are going to get stopped out at some point unless you've got, hundreds of thousands of dollars to back up that position and stay short for long periods of time. And so, like I say, that is what's really nice about this, because I feel like I don't want people to say, oh, well, then I'm just going to sell my whole account's worth of crude oil when it gets above $90, and I'm going to buy my whole account's worth of crude oil when it gets below 40. No, you have to, first of all, stay small and be ready for the market being above or below those prices for extended stays. Now, how do we do that? First defensive mechanic to me is always, 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 before you even put the position on, just get smaller. And the small exchange products allow you to do that. And even if you want to scale up, you put one on, say, Mikey, and the market goes against you and you're like, this isn't even as much risk as I wanted, you can add another. So get smaller to start. And then after that, you can cover your positions with options and you can roll out in duration. If maybe you want to speak a little bit towards that idea with, say, the crude oil example, if I got short SMO up here, Mikey, how could I cover that position? And then also, how do I roll that out in duration?
Yeah. And I think even when it comes to the interest rate trade we just placed, like getting smaller could mean just taking the other side of a correlated product. So like getting short the 2-year and long the 10-year is a way to get smaller because you're hedging your risk on both of those products.
That's exactly right. And then, aside from that, it's a matter of like, if I'm short, I can sell puts. If I'm long, I can sell calls. And then futures and options, you can roll them out into duration, continue to get credits and everything else, and elongate that process. If, like Mikey said to start, if VIX is elevated for a couple of months when you thought it was going to be a couple of days, or crude oil is above 90 for a couple of months when you were hoping it was going to be a couple of hours, make sure to get small, cover those positions, and roll out in duration.